Some things never change. One of them is monetary and fiscal policy's perennial search for coherence and stability. The two policies are simply too closely intertwined, and their influence on the economy too powerful. Over the past year, we have seen the latest example of tensions. Monetary policy has been restraining aggregate demand to quench inflation. Fiscal policy has been boosting it to shield economic activity from higher commodity prices. And higher interest rates have been widening fiscal deficits. But the challenges go way beyond the short-term policy mix. They have to do with long-term trajectories and their cumulative impact. This is the focus of this year's Annual Economic Report. To shed light on those challenges, we put forward the notion of the region of stability. The region maps constellations of the two policies that foster sustainable macroeconomic and financial stability and that keep tensions between the two policies manageable. We reach three conclusions. First, even before the COVID crisis struck, the two policies had been approaching the boundaries of the region. Hence the recent unique combination of high inflation and widespread financial vulnerabilities. Second, looking ahead, long-term government debt trajectories pose the biggest threat. They have been relentlessly narrowing the region of stability, and they will continue to do so. Finally, operating firmly within the region calls for adjustments to strategies, institutions, and above all, as Agustin stressed, mindsets. The objective is to dispel a kind of growth illusion, a de facto excessive reliance on monetary and fiscal policy to drive growth. Let me say a few words about the nexus between monetary policy and fiscal policy, as well as the region of stability, the journey to the boundaries, the risks ahead, and the policy implications. Monetary and fiscal policy are inevitably closely tied together. They give the state privileged access to resources through the issuance of money and the power to tax, respectively. They back each other up. Monetary policy can avoid the government's technical default, and the power to tax ultimately backs the value of money. They operate through intertwined balance sheets, those of the central bank and the government. Their transmission mechanisms overlap, notably through financial conditions, and they have a major impact on the economy. With this great power comes great responsibility. The region of stability, illustrated in this graph, delineates the range of policy settings that are consistent with the proper exercise of that power. Drifting outside the region generates large economic costs, slumps, high inflation, and financial instability. The region's location, size, and shape depend on the state of the economy, not least that of the financial sector. In turn, the state of the economy depends on two sets of factors. One includes factors other than monetary and fiscal policy. Think, for instance, of non-economic events, a war or a pandemic, or of long-term economic forces, for example, globalization and financial liberalization, or of other policies, notably prudential policy. The other set comprises monetary and fiscal policies themselves, in particular their past trajectories and their cumulative impact on the current state of the economy. Think, for instance, of the impact of past deficits on the level of government debt, or of that of long periods of very low interest rates on financial vulnerabilities. Now, two important features stand out. First, the two-way feedback between the state of the economy on the one hand and monetary and fiscal policy on the other opens the door to intertemporal trade-offs. Policy settings that may appear reasonable, indeed compelling in the near term, may cause problems down the road. Second, the contours of the region are fluid and can be hard to discern in real time. They may become clearly visible only ex post, and instability may emerge abruptly as confidence evaporates. These two features figure prominently in the journey that has taken the two policies to the boundaries most recently. Even before the COVID crisis struck, the two policies were approaching the boundaries. As we see in this graph, globally, after a long string of deficits, government debt in relation to GDP had climbed to historical peaks. Interest rates in nominal terms had fallen to historical troughs, while in inflation-adjusted or real terms, they had been negative in the wake of the great financial crisis. And central bank balance sheets had reached wartime peaks. Ostensibly, policy buffers and safety margins had become uncomfortably small, leaving the economy highly exposed and vulnerable. Policies did manage to ease aggressively once again as the COVID crisis struck, but at the cost of flirting further with the boundaries and laying the ground for the recent economic dislocations. Looking at the longer journey back to the 1970s, this was not the first time that the boundaries were tested or breached. All such episodes shared one feature. Policies underestimated the constraints on economic expansions. That said, as we see in this graph, the symptoms evolved over time, along with the changing nature of the business cycle and the signals of impending recessions, the vertical lines. Until the mid-1980s, the red lines, at least in advanced economies, the signal was rising inflation. The first panel, think of the great inflation of the 70s. Thereafter, and that's the blue lines, until the COVID crisis, it was the buildup of financial imbalances. The second panel. Imbalances here are denoted by the deviation of the credit to GDP ratio from a slow moving trend. Think of the great financial crisis, of course, as the most spectacular example. This helps explain the gradual loss in policy buffers following the mid-1980s. Policies became less systematically countercyclical. Monetary policy, third panel, blue line, had little reason to tighten during expansions as inflation remained subdued, thereby accommodating the buildup of financial imbalances. But it eased strongly and persistently to fight the recessions, now at times exacerbated by banking crises. These financial recessions, in turn, drove large holes in the fiscal accounts, fourth panel blue line, that were not replenished in subsequent upswings. In the background, powerful long-term tectonic forces were also shaping the journey. Financial liberalization amplified financial cycles, and the globalization of the real economy helped central banks hardwire low inflation. In a nutshell, after the mid-1980s, low and stable inflation masked the constraints on economic expansions, encouraging policymakers to test them. Partly as a result, as we see in this graph, growth became increasingly reliant on debt accumulation, both public and private, the red and blue stacked bars, respectively. The journey in EMEs was similar in significant respects. After all, the same long-term forces were at play. Hence, as seen in this graph, a similar evolution of key indicators: inflation, the policy rate, the fiscal balance, and public debt. However, regional and timing differences aside, the journey differed in one critical respect. These countries have been much more sensitive to global financial conditions, notably to monetary conditions in advanced economies, especially in US dollars, the dominant international currency. Thus, the exchange rate has also played a more salient role. This long journey explains why today we are seeing a unique combination of previous symptoms. In part because of the policy response to COVID, inflation has surged. In part because of a long phase of very low interest rates, vulnerabilities have built up and financial stress has broken out. This makes the current situation particularly challenging. What about the risks along the journey ahead? As monetary policy normalizes, The biggest risk is the unsustainability of government debt trajectories, a factor which, as shown in this graph, has already started weighing on credit ratings in both advanced and emerging market economies, the red and blue bars, respectively. Now, let me stress that the recent inflation flare-up has cut debt to GDP ratios only temporarily. As we see in this panel, historical evidence indicates that in both advanced and emerging market economies, higher inflation has, if anything, ushered in higher, not lower, debt to GDP ratios in the following years. The impact is hardly different from zero, even at high inflation rates, the left-hand dot and whisker. Stylized projections underline the long-term risk to government finances. In this graph, we see that even if interest rates stay below growth rates, absent consolidation, debt to GDP ratios are set to climb in the long term from their current historical peaks, the red lines. The increase would be substantially larger if one factored in the impact of aging populations, the blue line, and those of the green transition and of higher defense spending linked to possible geopolitical tensions, the purple line. Should interest rates exceed growth rates again, the self-reinforcing dynamics would be naturally much stronger. Moreover, as we see in this graph, it is not uncommon for the differential to switch sign. To get a sense of the possible impact of high debt, this graph illustrates that if today interest rates were as high as those in the mid-1990s, which was a kind of typical level, I would say, all else equal, debt service burdens would, over time, exceed their historical peak. This grim outlook for government debt is quite worrying. It raises serious risks for price and financial stability. So let me consider each in turn. Fiscal policy can greatly constrain monetary policy in its fight against inflation. Within a certain range, the constraints are manageable. Expansionary fiscal policy increases the required degree of monetary policy tightening, but only to a limited extent. Central bank independence can provide sufficient safeguards. But when the credibility of fiscal policy or the creditworthiness of the government are lost, monetary policy can be hamstrung. A tightening would only heighten those concerns and fuel inflation, typically through an uncontrolled exchange rate depreciation, a form of fiscal dominance. As we see in this graph, stylized empirical evidence is consistent with these considerations. The inflationary impact of fiscal expansion is greater when the fiscal regime is less concerned with fiscal sustainability, as denoted here by spendthrift rather than prudent. The yellow bars are higher than the green bars. Moreover, extreme situations aside, central bank independence is key. The right-hand bars are considerably higher than the left-hand ones. Fiscal policy can also constrain monetary policy by triggering or amplifying financial instability. The direction of causality between fiscal policy and financial instability goes both ways. On the one hand, high sovereign indebtedness can cause financial system stress by generating losses for financial institutions, either because of their exposures to sovereign debt or simply by destabilizing the economy. This is a key reason why government and bank credit ratings tend to co-move, as illustrated in this graph for advanced economies. On the other hand, financial system stress, regardless of its origin, can cripple fiscal soundness. It can do so directly, as the sovereign may need to backstop the financial system, and most importantly, indirectly, as the economy tanks. As we see in the right-hand panel, the surge in public sector debt following banking crises is typically well above 10 percentage points of GDP in both advanced and emerging market economies. The two-way causality can give rise to the infamous sovereign bank doom loop. Post-GFC in particular, as sovereign debt has soared, financial institutions have absorbed growing amounts. As an illustration, this panel shows an increase, or the increase in relation to bank capital in both advanced and emerging market economies. Given the lengthening of maturities shown in this panel, exposures to interest rate or duration risk have grown substantially, even where central banks have engaged in large-scale asset purchases. The corresponding potential losses can be sizable. Indeed, in the year under review, we have already seen how interest rate risk alone can give rise to stress in the system. Think of the turmoil in the UK gilts market or of the failure of a number of US banks. The stress would be much more severe should the creditworthiness of some sovereigns be questioned at some point. What are the implications of this analysis for policy? The overriding priority is for monetary and fiscal policy to operate firmly within the regional stability. This requires adjustments to strategies, institutions, and mindsets, well beyond monetary and fiscal policy themselves. For fiscal policy, it is essential to ensure that that evolves along an unambiguously sustainable path. This is the cornerstone of a well-functioning economy and a prerequisite for monetary policy to retain headroom. Regarding strategies, it would be important to pay greater attention to the impact of financial factors on fiscal space, notably to the flattering effect of financial imbalances and to the potential fiscal costs of banking crisis. Regarding institutions, it is crucial to give fiscal councils and fiscal rules more bite, possibly through constitutional safeguards. For monetary policy, the priority is to ensure price stability while paying due attention to financial stability. Regarding strategies, once price stability is re-established, it would be desirable to exploit the self-stabilizing properties of low inflation regimes, documented in detail in last year's Annual Economic Report. This means greater tolerance for moderate, even if persistent, shortfalls of inflation from narrowly defined targets. Greater tolerance would also reduce the incidence of long periods of unusually low interest rates, thereby limiting their side effects, such as the buildup of financial vulnerabilities, the misallocation of resources, and the incentive for governments to accumulate debt. Regarding institutions, safeguarding central bank independence will be even more important if fiscal positions continue to deteriorate. Two additional policy areas can substantially enlarge the regional stability. One is prudential policy, the first line of defense against financial instability. An effective prudential framework involves a whole range of elements. Concerning sovereign exposures more specifically, there is a need to revisit the favorable treatment of sovereign debt in market and credit risk. Another badly neglected area is structural policy. High sustainable growth can be achieved only through decisive measures to improve the supply side of the economy. Structural policies have been flagging for too long. They need to be revived with urgency. Ultimately, however, and let me conclude with this, a change in mindsets is called for. A keener recognition of the limitations of demand management policies is key to overcome the growth illusion that I described earlier. The concept of the regional stability, hard as it may be to apply in real time, can promote the necessary shift in perspective. The concept is, first and foremost, a lens through which to look at the world and to guide policy. It can help preserve the vital trust that society must have in the state and its decision-making. Thank you.